Hi, I'm Linda Eedes. This is an update on the RECM Balanced Fund, which is of course our Regulation 28 Balanced Fund, looking at the second quarter, talking to some of the movements in the markets, both globally as well as locally, talking to the impact on this fund itself, some of the new investments that crept into the portfolio over the last quarter. We have some new global holdings, we have some new local holdings as well, and then talking to the overall positioning of the fund given that backdrop. So the fund was up 0.7% after fees during the second quarter. And if one looks at the all-share index, which was up 3.9%, and the S&P 500, which was up more than 4% during the quarter, and the MSCI All Countries World Index, which was up more than 3% in US dollars over the quarter, the fund's returns look fairly lackluster. But I think what one needs to do is stop and question what the major driver was behind that rally in equity markets. Now, bear in mind that the S&P 500 has reached new all-time highs. What caused this? Well, the US Fed came out and said that instead of actually hiking rates, they actually feel that they might need to start to cut rates to actually give some stimulus to the economy. So that is not a good thing. If you consider the fact that US equities are already at fairly elevated levels relative to their history. If you consider the fact that the gap between the most expensive stocks, which of course include sort of the growth stocks like the technology stocks, and the cheapest stocks in the US market, that dislocation has only ever been wider just before the Great Depression and just before the dot-com bubble burst. This really sort of poses some very interesting questions as to whether that response, that global equity market rally, was an appropriate response to what exactly the US Fed is signaling. For us, we don't know what's going to happen in future. We would rather stack the odds in our favor, in our investors' favor, by buying businesses, good businesses, but with one very key feature, that they are trading at very attractive prices at a significant discount today relative to what we believe they're fundamentally worth. Because that margin of safety is absolutely critical in terms of providing us with some buffer against things turning out to be different going forward. And certainly the US Fed is telling us that things are turning out to be different than they in fact were signaling previously. So if you look at the Balanced Fund, it's actually very conservatively positioned, and that's done investors very well over the last 3.5 years. Since the beginning of 2016, the market has really kind of turned back in favor of value-oriented strategies locally, particularly. Not so much on the global side. Globally, value still tends to be underperforming, as it has done over the last decade relative to more growth-oriented strategies, which include technology stocks. And one can see why with that continued rally. But since the beginning of 2016, this fund has delivered to its investors over that 3.5-year period, 32.5% after fees on a cumulative basis. Now, the average of that sector, in other words, the average fund in that same sector, in that ASISA sector, has delivered 14% over that time period. So maybe the average fund isn't a good enough measure. But if you even compare that to the equity market, to the all-share index, bearing in mind that this fund cannot be 100% invested in equities because of the regulatory restrictions, the all-share index delivered 25% over that 3.5-year period. So this fund outperformed the all-share index quite significantly, despite being constrained in terms of how much equities it can hold. And that really came from a lot of that value unlocking in different parts of the portfolio. It came as a result of what we're willing to invest in, our style being value-oriented, but also as a result of our size. We have the widest opportunity set available to us as South African investors. So for the majority of that fund that needs to be invested in South African equities, we can invest across the board from small caps, mid caps, through to the large caps. Now, there's this perception that if you invest in small and mid caps, that you, by definition, have a more risky portfolio. If you consider where the downward price action has been over the last few years, certainly the headline-grabbing stocks have been those which have been in the top 10, top 20, top 40 stocks of the all-share index. And by that, I'm referring to Steinhoff, I'm referring to Aspen, I'm referring to MTN, BAT, Woolworths, Mediclinic, all of these are significant companies on the JSE. So these stocks are all down more than 30%. So certainly there isn't protection against downward price risk just investing in large cap. In fact, you have a far better chance avoiding such downward price action by having a very diversified portfolio across the board. And we really do give something very different to investors to what they perhaps get from other funds that they may already have in their portfolio. By virtue of our willingness to invest in stocks which are undervalued, having to have a bit of a contrarian slant to that, and our ability to invest across the opportunity set wherever those opportunities present themselves. So turning to some of the things that contributed to the quarter in terms of the returns, gold producers in the portfolio contributed. We have a little bit of a gold basket as insurance against things going wrong. Platinum producers continue to add to returns. Finally, platinum, after many years of woes, has actually delivered some returns for us over the last year. And the luxury retailer Richemont. The domestic businesses are the ones that came under pressure over the last quarter, as they did during the first quarter. So year to date, really it's been the local industrial stocks which have struggled. Some of the new investments in the portfolio include Netcare, the private healthcare service provider, which has become cheap. We did have some exposure to Mediclinic, which we switched into Netcare. We prefer Netcare. It's now as attractively priced. It has less debt, and it's further down the lines in terms of correcting its missteps into the global market than the others are. We introduced Santova, which is a logistics business. Spur. Now, Spur is a 2.5 billion rand market cap company. It is a very high quality business if you actually look at its fundamentals and its history. It's been through a bit of a difficult time of late, combination of local economic conditions, the boycott against them when they had that incident that went viral on social media. They faced some tough times, increased competition, and we were able to introduce a small stake. Now, that business is an incredibly attractive business to own if you can buy it at an attractive entry point. That is not even available to the larger managers just because they cannot get any meaningful allocation to it. We would prefer to have a bigger holding. We will be watching it closely, and hopefully we'll have an opportunity to increase our exposure there. TrendCore is another addition on the local side, as well as MultiChoice, which is part of our spin-off basket. Globally, we introduced Brookfield Asset Management, which is an infrastructure and renewable energy company. Michelin, the tire manufacturer, quite defensive exposure there. IBM, which has come under quite a bit of pressure and now has a stab at the clouding business through its acquisition of Red Hat. Dixons, Royal Vopak and Royal Boskalis Westminster have a common anchor shareholder. They are both Dutch-based companies which are really multinational in nature. One is a tank storage business and the other is a sort of underwater dredging business. And Leondol Bessel, which is one of the biggest chemical producers in the world. So our offshore exposure is now pretty much at its maximum at the 30% mark. We do still have a little bit of cash in that global portion. We actually did increase our global equity exposure though, as you can tell from the new stocks in the portfolio. So what we have is a very varied portfolio of different assets across different industries, on the global side across different geographies, all which will react to different sort of catalysts in terms of what will unlock that value, which provides for a very robust portfolio, which should deliver good returns to investors no matter what the future holds.